40% of the S&P is in or directly related to AI. That's a big bet. Many people might not know that they have made that bet if they own the S&P 500.
When are we going to stop talking about stocks or bonds as public stocks versus private stocks? Because private markets bring something different to a portfolio. But at the same time, there are fewer and fewer publicly traded stocks. And there has to be a point where we say, listen, to your point, maybe we're getting too concentrated.
If you look at the transmission of decision making, individuals make mistakes quickly, committees make mistakes slowly, right? But they tend to make the same mistakes.
I rarely hear people ask, where do you get your information? But I think it's a really good question to ask. Welcome to today's show. I'm really excited today to have Brad Long, Chief Investment Officer of Fiducient Wealthspire, with us. Now, Fiducient Wealthspire is focused on many markets, from everything around pensions to family offices to advisors like us. So with that, I want to get started, Brad, and have you just give us a little background about how you got here and what's driven your passion for your role as a CIO.
Well, John, thanks for having us. Appreciate being here. Passion, it's an interesting thing. I really came to this, call it unique corner of the market, for two reasons. One is, coming through college, I was just terrified of the Dunder Mifflin job, right? Where you kind of go somewhere, you push paper, you don't really love what you do. And investing is just always different. Even if yesterday you had all the information and the perfect approach, today is new. And so that intellectual rigor, it excites me. It's something that I love and lean into. And so just career-wise, it was something that I really ran towards. Once I got into the industry, though, I figured out the other thing is I love the tangency in this pocket, right? We're not just investing, we're working directly with clients, of working with those clients and seeing the outcomes that we produce, right? The benefits that we create and its influence, or, if we misstep, right, what that creates for those clients. And so it's kind of that foxhole effect, right? You're not really fighting for the cause, you're fighting for the person next to you. And so the colleagues, the clients that I get to see and work with every day, it's the reason that, late at night or on the weekends when my wife's like, get off your computer, I'm like, just one more minute. I need a little bit more time. I think those two things really help me just love the work that I do.
That's cool. So today we're going to talk a little bit about how to build portfolios. We'll get into a little bit about markets, but I also want to be clear that a lot of what we do is about building long-term answers, not just worry about where the short term is. So starting there, what's 2 or 3 big decisions that drive most of the outcomes in a portfolio?
I mean, look, we could spend the entire show on just this idea. If you really narrow it down to the handful of things, you kind of got to get right. One is asset allocation. It's the primary determinant of success. If you tell me I'm a 100% stock portfolio or 100% bond portfolio, most individuals, institutions, investors are not going to meet their long-term goal with 100% bonds, right? You need some kind of mix. And so getting that mix right matters a lot. The second is mentality, right? Like anthropology, the fight or flight, right? Our instincts as humans really lead us to make bad decisions when it comes to investing. We love doing things that are comfortable, and we hate doing things that are uncomfortable. And rarely what is comfortable is profitable, and vice versa. And so having that long-term approach and kind of intermediating or disrupting that emotional response that we often have helps us succeed. So get the asset allocation right, get the emotions in check. And that's, candidly, one of the reasons advisors add so much value, is to help in that almost psychology component of investing.
Mm-hmm.
And then the third is, it's not just what you earn, but what you keep. So for every investor around the planet, you're taxable or not, that's talks about fees, right? All else equal, higher fees is lower returns. But if you're a taxable investor, after tax and after fee is what you can spend, right? It's your mortgage or milk or, whatever it is. That is critical. Having an optimal portfolio that, is designed with fees in mind, but also knows that after tax is critical and having efficiency there. So get the allocation right, get the mentality right, and focus on the net after fee, after tax. You get most of those 3 buckets correct, you got a pretty good chance winning the game.
Let's jump into that asset allocation question a little bit. It was easy in some ways to allocate money in a zero interest rate environment, and now things have shifted in the past few years. Like, what's changed about allocating assets over in a higher interest rate environment from a low interest rate environment? And I say that thinking we're going to be in a higher interest rate environment for a longer period of time. It's not just going to go away.
Well, I mean, one of the things that has changed, and in a very good way, is that fixed income was earning almost nothing, if not a positive real return, a slightly negative real return. That is federal policy. When you cut rates, right, and interest rates are low, it creates these animal spirits that make you want to go out and buy equities and buy private equity and buy these other things that are going to have a higher return. As interest rates have risen, and you can generate a meaningful rate of return to help offset risk or help in retirement or achieve your goal. That's a great thing for us today. That allows investors to not have to ask themselves either, I'm going to earn nothing on fixed income or I'm going to go take a lot of risk. Now I can say, actually, I can earn something on my fixed income and I can choose to take risk where it's appropriate over the long term. So that's been good. Now in today's market, there's a lot of nuance, right? We've talked about three primary themes that really influence outcomes: concentration, especially here in the United States, valuation, and inflation. Those three things together, they're not new. They might not even be unique, but they are important. 40% of the S&P is in or directly related to AI. That's a big bet. Many people might not know that they have made that bet if they own the S&P 500. So it's not just, first it's acknowledging that, and then it's managing that, both the offense and defense components of that. Valuation, all else equal, right? Over the long term, as you mentioned, John, we want to be long-term investors. Over the long term, higher valuations is lower return. So what do we do about that? How do we manage that in this environment? And then inflation is a very important part, not just to our daily lives, right? Of how much it costs to purchase goods and allocate and spend either pre-retirement or in retirement, but it's also a really important input into our overall portfolios and the potential opportunities and risks. And if you zoom all the way out and you think about kind of a rubber band of inflation, it's being pulled harder and harder in different directions. The inflationary one is we have a very high and growing deficit. We have large deficits today here in the United States and globally. We have tariffs and somewhat of a more bipolar world, call it, China on one polar end and call it NATO or the US on the other. That creates more friction of goods as they move around the world. And so that's generally inflationary. On the other end, you have things like AI, right? If AI is really democratizing intelligence to $20 a month, not $40 an hour, that can be disinflationary. And that there's a lot of important elements that we need to start understanding there. So the combination of those three in today's world are really important factors as we build a portfolio.
Well, and when you say all that, one of my thoughts, and I always am this guy, is when do you change your mind and say, we thought we were heading down this path because of this theme, and maybe we're wrong?
So we always say when the facts change, our opinions may change, right? So the first thing in that sentence is facts. You have to start with the evidence, right? We are not a kind of, oh, well, it feels a little different or the wind is blowing in a new direction. That gets back to that behavioral element of people tend to make the wrong decisions at the wrong times. So we have to evidence base the decision around facts. Then you interpret those facts, right? It might tell you, hey, your operating assumption was X, but now it's Y. But does that mean we should change? Should we take action, and why or why not? If we were to meaningfully see a reacceleration in inflation from what we thought would be the case, and that happens, make up a time period, June. I'm not saying that this is our prediction, if you will. The facts have changed, right? That may change our view on where risks lie, where opportunities lie. And so and again, getting back to that dynamic world, like something that I love, like the facts are always changing, but it doesn't necessarily always compel action. So that interpretive layer, right, of using evidence to interpret to what is meaningful and then reacting to what is meaningful is that's the translation error that's critical to getting it right over the long term.
I think you point out something that's interesting. Sometimes the facts may make you not change, and making that decision is still an active decision. So I find that point something I try to bring up a lot with clients. So to your question, to your point, are you seeing anything right now that would lead you to believe that the facts are changing on the ground, or are you just of the mindset that no, we're in a good spot? And with that, what is a good spot? Because there's always things that diversify a portfolio more than other things in certain markets. What's diversifying the portfolio today that probably didn't work 2 years ago?
Yeah, well, if we're not in a good spot, we're not. I'm not doing my job. So of course, I'm going to tell you I think we're in a good spot. Um, I do, though. We can evidence that, and it doesn't just come through return, right, and through intuition and analysis. As I mentioned, AI in the United States today in the S&P 500 is a very concentrated bet. If you were to, again, just start with a true blank piece of paper and say, hey, you're going to go invest your portfolio. How much are you willing to put into one theme? Your opening bid probably wouldn't be 40%. Some might say 5, 10, 20, right? How much confidence do you have? Maybe I'll put a quarter of it in there. You probably wouldn't start with something closer to 40. And so as we think about the right spot in the right context and how we manage that, there's a defensive element to that, as I mentioned, right? You don't have too many concentrated bets. And then there's an offensive element to it, where AI can be beneficial, right? So we've talked about the broadening and the influence of AI and what it means to certain sectors or segments or capitalizations. Mid cap and small cap, I think, have certainly been an opportunity where utilizing kind of that democratization of, let's say, intelligence, whether it's sophisticated mimicry or true intelligence, we can have a different podcast for a different argument, but that is an area of the market where you can develop some conviction, and we have, and that's been, I mean, we're sitting here in early March. It's been additive year to date, a lot of wood to chop still, but we, have, and continue to believe that there is opportunity there. But John, you also asked about like, what is diversifying, and small caps and mid cap, right? We think that's an area of the market today where there's opportunity, but if the proverbial spaghetti hits the fan, small caps and mid caps are going to go down like large caps will. The question will be the order of magnitude, and that's not diversifying as we think about those type of environments that create that kind of bone shaking level of volatility. And that's where you have to come back to first principles, like what is true diversification. It's not the fickle friend diversification. We still think high quality assets, whether that be across an asset class like high quality fixed income, or even quality differentiation amongst a single asset class, right? Not all fixed income is alike, right? There's IG, there's non-IG, making sure that you're positioned appropriately. Those are the areas of market that we can and do look probabilistically across the whole portfolio and say, this is what we think the future holds, but we know that we don't have a crystal ball. And so we have to plan for some of these other potentialities. And having that true diversification and high quality is one of the things that builds resilience and durability to portfolios, even though we know we don't know what the future holds.
Yeah. And you didn't mention international, so I want to touch on it just because for 10 years, 15 years, even advisors for career risk were starting to say, screw international, right? That's not where we're at anymore. The past year's been decent. Going into this year's been okay. So how does international diversify it? What's changed in the world that makes international suddenly interesting?
Yeah, I mean, there's a handful of things. So maybe let's start first on defense with AI, right? It's 40% of the S&P interrelated to AI. One of the ways that you mitigate that risk as an investor is you own something other than AI. If you look across the pond, whether you go to Asia or Europe, there's a lot less AI, a lot more things that are tangible, materials, industrials, financials. Those are areas of the market that, in 2026 have certainly been compelling parts of the market. But also, as I mentioned, valuation, right? All else equal, long-term returns, the higher the valuation, the lower expected return. We've seen a very materially different market outside of the US than we have seen in it from a valuation perspective. So, to your point, advisors for years, they may have owned international or not owned international or bailed on international. In 2024, when we were overweight international, we looked like idiots. In 2025, we looked like heroes. As you mentioned, year to date, it looks similar. But if you come back fundamentally, international from a valuation perspective is more attractive, right? We think it's got a higher long-term expected return. Some of the dynamics that we talked about with U.S. spend deficits, maybe some pole position changing in the Fed. Those can be in the short term. Dollar weakening, it's a tailwind, right, for potential international investments. If the dollar weakens and you own something abroad, when you translate it back to dollars, that means it's worth more because the dollar is weaker. And then you just have a true reacceleration of fundamentals outside of the U.S. You can see that expectations and realization of earnings and earnings growth across Europe, across emerging markets, has been strong and continues to grow. When you start to combine and stack those components, you build greater and greater conviction that over the long term that's going to be the right, where the puck's going. And so again, 2024 we looked like idiots. 25 we look like heroes. We'll see what 26 holds, but we think it still plays a very meaningful role in portfolios, and being overweight today, I think it continues to be so. Now, short term though, there is AI has been kind of working its way through markets somewhat systematically and asking or forcing people to ask somewhat existential questions like, will this industry exist in 5 years? Or what does this mean? Software is having its moment in markets in 2026. There's been a reflexive element to that where investors have gone and just said, well, I'm going to buy what is tangible, what I know exists, what will be needed in the future. Energy, materials, industrials, et cetera. Those are areas of the market in the US as well that have succeeded. But as I mentioned, just from a market structure, there's a lot more of that in Europe, a lot more of that in Asia. And that has also been a tailwind. So a lot of confluence of factors, both long-term, fundamental in nature, but also shorter term that have been driving international's relative success. And year to date, it's been pretty substantial.
Let's talk about AI for just 5 minutes or less, because I think AI is the existential question. How is that changing investing? Because to your point, we're past the phase of we got to buy something, just the chips. We're now in the phase of all companies can benefit. Everybody's going to see potentially stronger margins. So that should change it. But then when we look at other factors, you could see maybe more unemployment. You could see there's all kinds of things that play into this. So how should we be thinking about AI in today's world?
I would say there's call it three components if I had to distill it down. So one would be around what we talked about, that deflationary factor of AI, right? And that's also could translate, John, to your comment on higher margins. The difference between higher margins and deflationary is the connector is labor. So what the market has largely been wrestling with as of late is the hyperscalers, let's just call them, are putting $750 billion into AI investment. And by the way, I was out to dinner with my son last night. He's turning 11 on Friday. So I was taking him out to dinner and can't remember what we were talking about, but when we say million, billion, and trillion, it's easy to forget the order of magnitude and shift, right? A million seconds is 11 days. A billion seconds is 32 years. A trillion seconds is 32,000 years. So even though it's just a changing consonant, like a million and a billion and a trillion are very different. And so $750 billion is a lot of money. And the market's trying to answer, is this money good? Is this money that is going to produce a positive ROI that is going to benefit these businesses? And the jury's out. The thing that the market has not been talking about as much is labor. And so, John, you mentioned higher margins. If a business needs to invest less in people and get more out of technology, in theory, it can have higher margins. But the US economy is 70% consumption, right? The majority of our economy is driven by people buying stuff. If people don't have a wage to buy stuff, the US economy does not do well. So if there's a replacement factor associated with AI and labor, then that's both deflationary, but it might be good for a company or some companies, but not good for the economy. And how do you start to square that circle? It's difficult. Now, I will say before anyone either throws away the idea of AI or believes, in kind of the Terminator scenario and it's coming for us. The world likely lives in between. There are roles, there are functions, there are things that the democratization of intelligence will absolutely influence labor. But it will probably take a long while. We don't believe that that's an overnight thing. We actually built a labor and consumption model to look at BLS codes, and we stress test their AI replication, right? Can you take this role out? And looked at how much do they spend across the cohorts of US GDP. And if, over the next 3 years, you get pretty material replacement, it could be called a 0.25% or a third of a percent drag on US GDP, but that doesn't equal recession, right? That probably equals higher margins, albeit for individuals who lost their job. Hopefully they're not permanently disintermediated, they find a new role. But that could also be deflationary as well. And that does start to connect the circle on Kevin Warsh and the Fed and what he would love to achieve. His Pollyanna environment is that productivity increases, which is deflationary, so they can lower the Fed funds rate and run a little bit hot on economic growth without having subsequent levels of inflation. That would be a big departure for the Fed, which we can talk about because it wouldn't be data dependent. It would be future looking. But AI it's here to stay. So the question is, what do you do about it? Both in your portfolio, in your business, in your life. There's a lot of ways that we could take that. I think in our portfolio, it's the offense and defense. It's making sure you don't have too concentrated a trade, that you have true diversification. There's the picks and shovels element of it, of energy production, chip production, power, et cetera. And then there's we want to own stuff that's not AI. Because if you're making one singular bet, like most of the families and institutions that come to us, they don't come to us because they don't have money, right? They're usually starting with money, and first order principles is keep it and then grow it. So we want to make sure that we're being cognizant of the risks that could include in portfolios.
Well, you brought up the Fed, so let's talk the Fed.
Here we go.
Yeah, I think what's interesting about the Fed, maybe this is a comment you can agree with, is that their data sometimes is dirtier than not. It feels like Warsh is saying that he wants to maybe change that a little bit. Maybe they'll use AI to get better data. I don't know. But to your point, there seems to be maybe a shift towards thinking about looking at things more futuristic instead of just in the past. What do you think the biggest changes are going to be? How is that going to impact the market?
It's important, I think, to remember a couple of things fundamentally. So one is, much has been made about Powell's expiration as chair, and Kevin Warsh, who's not been confirmed by the Senate, at least at the recording of this yet, but presume that he's the new chair, is that the chair is not the Fed, right? So first off, we just have to understand the FOMC, it's 7 appointed governors that have, a term that expands any given president. And then you also have a rotating regional federal governors that aren't, or rotating regional bank presidents, and the permanent seat from the New York Fed. So just because you're chair doesn't mean you get to say, okay, gavel lands and here's what policy is. The other is that the Fed is made up of people with imperfect information that all come to the table with their own biases, and they try to make a thoughtful decision. And really, post Greenspan, that decision has been anchored and communicated via data dependency. One of the things that markets love is clarity and consistency. They don't like uncertainty. When they're uncertain, they need to move away. They need to build a margin of safety, and that usually means the prices go down to some degree. And so the Fed has been communicating in a very programmatic way, and that's served well, both on the employment side of the ledger, on the inflation side of the ledger, outside of 2022, and on the transmission mechanism from the Fed to the market on here's what we believe and why. If you depart from that methodology and start to say, hey, this is what the future will hold, not what the past, the evidence is showing us, that is a departure for the Fed. For the Fed to, and this is not a statement they're making, but this would be an example, is that they were to say, okay, AI is going to influence labor. It's going to increase productivity. Therefore, that can be deflationary, and labor, unemployment would be rising. We need to lower interest rates to accommodate greater investment in the economy to offset that risk. That is a departure, right? That would be saying the future state is this, not the present or the past. I think the Fed has a long way to go to actually start thinking and acting that way, but we would see it. We would see it through their actions, through the dialogue, through the minutes. Um, and that would be one that the markets would have to grapple with and adjust because it would create greater degrees of uncertainty in Fed policy, which historically has really not been beneficial to markets. So we'll see where it goes, but we don't really anticipate, especially just because of the change in chair, that the Fed is now has a totally different beat to their drum and they're doing something new and unique. Candidly, I think Kevin Worth is going to walk into an environment where, now because of geopolitical risks, you have a headline inflation rising, yet unemployment remains low. He's not going to have open season on lowering interest rates. And so he's going to be pretty much stuck between a rock and a hard place until you start to see a crack in either direction of that data.
Let's pivot.
All right.
You and I have had a conversation in the past, and I'm going to put you on the spot here.
Good.
So the conversation we've had is, when are we going to stop talking about stocks or bonds as public stocks versus private stocks? Because private markets bring something different to a portfolio. But at the same time, there are fewer and fewer publicly traded stocks. And there has to be a point where we say, listen, to your point, maybe we're getting too concentrated. So let's just talk about that for a bit. What do private markets bring to a portfolio? How far are we from saying we're not going to have the conversation about private versus public? It's just, do you want to be in stocks? Do you want to be in bonds?
If you zoom all the way out and you think, again, I want to build a portfolio that helps me get to my goal, rate of return, a level of risk. Let's just use an apples to apples comparison. In the US, there's about 5,500 public listed stocks, right, that you can buy on exchange and trade. Not that you would want to buy or trade all of them. In the US private market, there's over 205,000 companies that have a revenue of more than $10 million. So it's not the single shingle sub shop or, the gentleman that, mows everybody's neighbor's lawn. It's, substantiated businesses that have, at least 10 employees or more. That opportunity set is very, very wide. And to ignore it is to ignore levers that could potentially help your portfolio, period. So private markets, private equity, private debt, private real estate, private infrastructure are things that we should consider. The more elegant version, I think, of the future conversation, John, that you're mentioning is, let's not talk public and private. Let's talk about tools that will help you achieve your goal. But then the translation mechanism of what public and private really mean is liquidity. I can buy Apple today, change my mind, and sell it today. Probably not a great way to invest, but that's available to me. If you buy a private company or you invest in a general partner like a fund, a private equity fund, that capital is unavailable or for liquidation for many, many years. For some investors, that's perfectly fine. For others, either mentally or practically, right, they need that liquidity in their portfolio, and it doesn't make sense. So the conversation should probably evolve and will evolve more to, okay, what is the level of liquidity needed? What is the objective you want to achieve? Should we be using private investments to help achieve that objective based on that framing? So it will be less. And by the way, the era of, because it's private, it will outperform, that was an assumption that was made. That is gone. It was never there, in our opinion. You should demand that it outperforms because you're giving illiquidity, or you're getting illiquidity, you're giving your liquidity to them. So you should require it, but it was never a pre-baked assumption. That was a little too back a napkin for many investors, and I think they're realizing that. So average private markets performance is not compelling, just as average market performance is not compelling, right? You have to do better. I do think that the conversation will evolve around public and private and just become more liquidity and asset.
Is there a decision factor that you should be thinking about if you're going to add private outside of liquidity?
Yeah, there's a whole lot of nuances there. If you're a taxable individual and you don't have a K1 today, like, Okay, that's kind of a pain in the butt, and you're going to have to file late, and maybe your accountant is ready for that or not. There's an operational component to it, right? If you commit whatever the number is, $100,000 to a private fund today, you're not writing a check today. You're pledging $100,000, and then they're going to call you when they're ready to buy a business, and you're going to have to give them 20,000 in 5 months, and 30,000. Like, so there's an operational function to it. So there is, and many advisors, great advisors, really help in setting that up, and it kind of grease the skid so it doesn't become the client's problem. But there are other practical things that you need to check the boxes to say, okay, this makes sense for me in my life, and what do I want to achieve. um, but it is an asset that, if used in the right way with the right context and with demonstrated skill, can help improve outcomes over the long term.
Yeah. Behaviorally, what I've seen is people get excited and want to jump into private markets, and they put all their capital into one thing, as opposed to what you and I would even consider smart. If you think about it from the 401k example, you put money in every 2 weeks and you dollar cost average into public markets. Why wouldn't you do the same into private markets and diversify your risk over many years? So it's just something I've always thought was a smarter way to get into it.
Yeah, you're right. People do get excited, and they'll kind of take the rifle shot, if you will. It's the one thing that they own. You want to diversify by vintage. You want to diversify by fund. So vintage meaning you're buying in 2023, 24, 25, 26, etc. You want to diversify by fund, right? So it's not just the one allocator. And then also, underneath the hood, you need to look at sector exposure or geographic exposure, depending on the asset. Um, a private equity fund. So there's a company that would be one investment. A private equity fund, it usually only owns 7 to 10 investments, right? If you were to make that a public equivalent and you were to buy a mutual fund or an ETF with 7 or 10 investments, you'd be like, oh my gosh, this is hyper concentrated. So, using those same principles of diversification in the private markets is 100% right. And so you're exactly right, John.
Let's step back a little bit. You work with large institutions, and large institutions allocate capital a certain way. Let's pretend that every individual has an investment committee with you on it. What's 3 practices everyone should adopt? And maybe go past that. Include in that 1 or 2 things that people currently typically do that they should abandon in helping them create a portfolio that actually works.
I love this question, because I have always said, and I say it with a smile, but I do believe it. If you look at the transmission of decision making, individuals make mistakes quickly, committees make mistakes slowly, right? But they tend to make the same mistakes. There was a great book that I read a handful of years ago. It's called Wiser. It was written by a behavioral economist out of Harvard, and it was really around the dynamics of committees making decisions. And they studied government and boardrooms, and what you often see out of those environments is that committees amplify the errors of individuals. And I'll give you the example. So let's say you have a committee and you have the expert of the group. Well, if that's just one individual and they make their own decision, right, it doesn't feel robust because it's just one. Well, there's this halo effect where the rest of the committee just relies or defers their thinking to that individual, but it feels more robust because everybody, they all vote, and then the committee voted, not the individual. And so we've actually thought a lot about that in our own decision making, right? Our own internal committees and how we've structured and vote. And so if you're going to build a committee, either literally or figuratively, and just surround yourself with people that can help improve the outcome, the things I would focus on is, first, you got to find people that you trust and that are aligned with your goal. So, like, let's just say a financial advisor, by way of example, if they're constantly trying to sell you something that's going to benefit them and you're uncertain if it's going to benefit you, there's a misalignment there, right? So it's hard to figure out, who are you really fighting for, me or you? So find people that you trust that are aligned with your goal. And then the second, which is easy to say and very hard to do, is you need to create an environment and have the people that have a dynamic that they're active listeners that are willing to question and disagree and, you know, effectively argue and create this more robust outcome, because committees often, defer to either maybe the loudest voice. They're not even the expert, they're just the loudest. Or they may be a true expert. And then there's a very narrow frame of decision. So find people that you trust that are aligned with your goal, whatever it is, and then create a dynamic where you have trust in an environment of disagreement, so you can build a robust dialogue and a robust outcome.
The interesting thing there that I'll point out is if you are looking for a robust dialogue, and I'm not trying to be super critical here, but a lot of advisors are building portfolios like just themselves, one person in a one-man shop building a portfolio using information from wherever. And so you don't get a very big dialogue. And I think that's what's interesting to me in looking at how people should be maybe asking questions different when they hire advisors. I rarely hear people ask, like, where do you get your information? But I think it's a really good question to ask. Let's push. I'm gonna push on that question again because you didn't really get into it. What should individual investors abandon right now when they're thinking about what that investment committee should look like for them? Because I think a lot of people do it a certain way and think that they know better than not. But what should they abandon?
Yeah, we talked about some of the fundamental things for long-term success, right? So asset allocation, not just what you earn, but what you keep. But the third component there was kind of your approach, your philosophy walking into it, and being emotionally driven. With one of the things, I think one of the reasons committees tend to make decisions, or they tend to make mistakes slower, is that there is this disintermediation of emotion. If it's your money and your capital and you're on your phone with your advisor and you see an event in the market that shakes you for whatever reason, you can call and just be like, hey, I want to fill in the blank. A committee, it probably meets once a quarter. There's, people in the group. That is one of the main benefits of committees, is that they help either slow that decision frame so that you can almost have to remain long term, but you also usually don't operate on a committee. Let's say it's an institution where it feels like, oh, this is my money, like it's hyper personal. Um, Abandoning that uh, tendency, that reaction to just want to let emotions drive. I've worked my whole life for this money. What do I do? What do I do next? Or I just read this in the Wall Street Journal. Or I was at the country club and someone said, hey, I'm doing this. And then you call your advisor, like, should I do that? Those are not robust frames of decision. Sometimes, you ask the question and then you go and do the work. The answer might be yes. Oftentimes, kind of whether it's the water cooler or a cocktail hour or on the golf course, that's not where you're finding the things that change the world. So I would abandon kind of that emotional element of letting it drive your portfolio and treat your portfolio like you want it. You want it to be this really well managed, professionally allocated, long-term focused portfolio that creates an outcome that helps you win the game, right? You want to retire, you want to keep that money, and achieve whatever your goals are. So abandoning that emotional response is probably the most important thing people can do. And by the way, we haven't tested that in a long period of time. 2022, we saw some volatility, but it felt more like investors understood the driver of volatility, and so they weren't emotionally attached to it. COVID, while a very unfortunate time in history, and the market reaction was about a cup of coffee. It was December to March 17th or something like that. We haven't been in an environment where we've been emotionally driven in quite some time, really back to probably the GFC. Whenever that comes, it's inevitable. When it does, making the right decisions at those point in time are the things that really help either clients, make a lot of money and stay in a course, or potentially make capital impairing decisions that hurt over the long term.
Does it feel to you though, like We used to say that institutional investors were better at the long-term thinking and retail investors tended to jump out of markets faster. Does it feel to you like that's shifting a little bit?
Yes, I think I have always been, and maybe it's a function of the position in which I sit, and that I will, go to a multi-billion dollar endowment board meeting and then talk to a family the next day. And I've always been very fluid across those worlds. I think the narrative of, these are wholly separate and different is perhaps overblown. And now that whether it's through technology or the introduction and availability to retail capital and trading, and I'm talking like at 1,000, fractional shares, Robinhood, you've kind of had this wave of that. On the same end, you have public markets in the short term outperforming private markets. That feels more like long-term committees are saying, "Hey, we put all this money into private equity, but the S&P is outperforming it. Shouldn't we be reacting to it?" So those are kind of both moving towards center. Um, yeah, there's a lot of flaws on both ends of those scenarios, but I would say that they are converging a bit. But the idea that these were wholly separate first was probably overblown.
I tend to agree with you on that one. So stepping back, I'm going to get close to the end here with you, but I have one or two questions. One was because you mentioned Robinhood, you mentioned, and they're always pushing the edges. What do you think we should be? I'm not asking you to prognosticate where markets are going. What do you think is changing in investing that's going to have a big impact over the next few years for people that many people might just miss if they're not in the markets like you and I are?
Yeah. So we talked about AI a bit. I would say, we're getting more and more conversations with individual investors. They'll get deep down an AI rabbit hole. And AI is an incredible tool, but tools misused create poor outcomes. And they'll have what they believe to be this kind of hyper sophisticated, deeply researched, investment thesis around something, but it ignores critical errors or, hallucinates in the worst way. But even if there's no hallucination, it's, like if you were to hand me a jackhammer, like I might be able to dig a hole, but if you need me to do something precise, I'm probably going to mess it up. I've never used a jackhammer. So finding the ways to use these tools and not let them drive the bus, I think will be very important. Moving from a world in which, we had globalization for a very long period of time, and now we have polarization. I think that that is going to be a very long-term issue that investors, if they're not paying attention to, are not going to see the seeds that it's sowing and portfolio influences on the macro. Um, we are in an environment where the bill is going to come due here in the United States at some point on both fiscal and monetary spending and the level of deficits that we have today. That's not a comment on President Trump, even though we are currently spending at a rate which we've only spent at in the past during past recessions, right? So we should be spending in recessions to offset the humanitarian or the labor impact from that. Government and institutions are spending at a rate that we're not in that environment, yet we're still adding to the deficit at the same rate. And that's not a comment on President Trump because President Biden did the same. And numerous presidents that have oscillated between blue and red have still produced higher and higher and higher deficits in spite of what they say on their websites. So we are coming into an environment where eventually the bill comes due. And the way that that usually translates is um, it's a whole lot of nothing until it's everything. Um, and so we have to, think about what that means to inflation, what that means to labor, what that means to market volatility, what that means to, the long-term status of the dollar. We're not calling for, the dollar to reserve its reserve currency status of the world. But you do have to think about the interplay of all these actions and the Fed we talked about earlier. So there are a lot of things that there are big puzzle pieces moving on the board. And if you're just looking at this stock is up today or it hit or missed earnings, you're probably going to miss like really where the tide is moving. And there is a lot of tide moving in that, in multiple directions. And so that's really where our jobs, where we live in markets and can zoom out to macro and zoom into micro and connect the dots. Um, if you're not a professional allocator investor, you just either don't have the time, resources, data, context, history, or an environment in which you can have thoughtful argument with peers to create robust outcomes, because that's not the day job. So I would caution kind of some of these bigger moving puzzle pieces on the board, because they're going to be very influential over the long term.
I agree. Let's close it up with the last question. What's one thing I haven't asked?
Who's going to win the Masters? I don't know. What haven't you asked? We haven't talked about crypto. It's funny how crypto goes into a period of silence when price is down, and it goes on a megaphone when price is up. But we haven't talked about that. It's not an area of the market where we have a long-term structural thesis that crypto will replace fiat currency. Um, Gold, by the contrast, is the shiny object. Pun intended. It is having its own Tina moment. There is no alternative. If you're worried about the US dollar, if you're worried about deficits, if you're worried about inflation, if you're worried about geopolitical risk, and you can add a long list of things to potentially worry about, which, by the way, is not new. That's old. Um, Gold seems to be a place to run. The only thing new in gold's camp today is that, through Russia's invasion of Ukraine and some of the polarization rather than globalization of economies, uh, central governments around the world are thinking they might not want to have as much money in US treasuries over the long term. And so they've been net buyers of gold. And because it doesn't really have much of an industrial use, its price is predicated on, the net supply, which is fixed, and then the incremental buyer, which has been growing. And so gold has certainly had its moment in the sun. So those are a couple of areas that we hear often that we didn't talk about. But honestly, as we think about, as you mentioned at the outset, how do you focus on long term? How do you get to actual outcomes? Even if gold or crypto is part of your portfolio, it's probably the minority of your portfolio. It's 1 to 5%. Where you should spend the majority of your time talked about is the things where the majority of your assets are and have the majority of influence on the long term outcome. And frankly, I'm glad we spent the majority of the time there.
Thank you, Brad. As always, I enjoy talking to you. And if anyone on this listening to this wants to hear more of Brad, you can go to Fiducient.com and see his videos. He's always fun to listen to. And with that, I want to thank everyone for joining us. And if you need to hear more from us, you can also go to BGM360.com. Everyone have a great day.